Hey folks, it's that time of year where everybody's asking for predictions for 2024. I thought we could look at a few things, and I was going to focus more on money, housing, and jobs and try to give folks some insight on what exactly is going to happen with those three categories. It's Vince Gaetano, it's the Wise Old Owl Show. Thanks for tuning in. Hope everybody's celebrating the holidays with family and having a good time. And the outlook for 2024 is not as rosy as some would think. The challenges that are out there are going to continue over the next 2-3 quarters. And I want to talk a little bit about what the Bank of Canada said at the last meeting. And Tiff Macklin made it very clear that we're going to have some difficulty over the next 2 to 3 quarters. And it's going to be bumpy. And people need to understand that the Bank of Canada really only has two tools in their toolbox, and that is interest rates, which impact the cost of borrowing, and the second one, forward guidance. And that forward guidance is something people rely on to kind of get an understanding of what is in sight, what is projected to happen, and really that's just an estimate provided certain statistics take place. Now, one thing that Tiff Macklin did indicate is he needs to get the inflation rate down to 2%, and it could be pretty sticky in that 3% range. When the December number comes out, it's not going to be good simply because last year's December number was at a 0.6 negative, which is going to be very tough to beat. So that's going to see an increase. And depending on what happens overseas and with oil, we could see a trend in heating and oil, gasoline prices going up. So we could see that bumpy road to that 2% target. It's going to be really tough to get there, but let's be wary of the speed in which rates are going to come down. It could take longer than expected. We are seeing some of the fixed rates move down. That is a good sign, but still that stress test to qualify for mortgages is still a challenge because it's hovering in that 6% range and above that target, the 6 to 7% range, and that is very problematic from an affordability perspective. Let's talk about money. Money will be expensive, and traditionally, folks that are coming off of renewals are sitting at an average rate of about 2.8%. Some are lower, some are a bit higher, but the overall average of folks renewing at their old terms is 2.8%. To put things into perspective, I want to drill down on an example of a $750,000 mortgage. If you had a $750,000 mortgage 5 years ago at that 2.8%, you're going to have a payment of about $3,000 on a 30-year AM, about just over $3,000, about $3,075 a month, okay? You're coming into a renewal 5 years later, your mortgage balance is going to be in the 660 range, 665 range, provided you just make monthly payments, and now you're facing a higher interest rate. That higher interest rate is going to be in the 5s, possibly 6s, okay? Your payment is going to balloon to about $4,200, $4,280 a month on a 25-year AM because 5 years has elapsed. So all of a sudden, you're going to experience a payment increase of 38%, okay? Now, that 38% represents about $14,000 a year in after-tax income that's going to have to go towards the cost to service the debt. Now, for folks buying their first home and, moving forward 5 years, a lot can happen. People start families, people have kids, kid expenses, daycare, all that sort of stuff. And chances are your income has not gone up by the same pace over the 5 years as you would need to match that payment. So all of a sudden, the cost of goods for borrowing, the cost that you're spending on borrowing is going up. It's going up at a level higher than what you're earning, which is going to put tremendous pressure on your disposable income. So all of a sudden, you got to start budgeting. You got to start being a little bit more thrift with your money, and things got to go. Those wants have to be eliminated. You got to focus on the needs. And this is something we've talked about over and over again. We're going to see the first 2-3 quarters of 2024 with people adjusting to this new norm. We have 75,000 to 100,000 people maturing their old mortgages every year, and this is going to be the big issue folks are going to be dealing with, okay? So they're going to have to scrape through. They're going to have to go through their savings. They're going to have to, just erode any type of investments and savings that they have to make up for this shortfall to stay in their homes if they do plan to stay there. Or they got to look at other alternatives. But the money part of the issue will be expensive relative to where they were coming from. And this will be also experienced on the rental side, as rental rates have been going up at astronomical levels. We've seen an 8% increase, 8.2% increase on just rents year over year. And this will continue to march up as investors and landlords experience increases to their borrowings on their investment properties, and they're going to want to make it up somehow. So you're going to see some crazy stuff in that world, and it will only be driven up by the demand for housing, because a lot of people won't be able to afford homes. Okay, they're going to have to rent. They're going to have to rent units with more people in them to try to spread the costs amongst more people. So you're going to see some different types of family units moving forward. That's my prediction. I think on the housing side, we're going to see some interesting things moving forward. As far as people buying homes, I don't think we're going to see the flush of activity that a lot of realtors are suspecting are going to happen in the first quarter and second quarter. I hate to be the bearer of bad news for all those realtors expecting some spark in business and activity in the first 2 quarters, but it's just not going to happen. Affordability still becomes an issue, and I'm going to get into the jobs issue in a minute, but the reality is there's not a lot of confidence. People who buy have to buy with confidence, and if there is a lack of it in the marketplace because the economy is slowing down and there's less spending going on, it's very difficult to try to align what is going on with potential bursts of activity on the real estate front. So we will see more listings, we will see more choice, but we're not going to see a whole lot of activity because people are going to be very gun shy pulling the trigger. And as I tell most of the folks that are out there buying right now, be patient, don't rush into things, and be in control of the property that you're engaging to purchase. Ask for your conditions. Make sure you're in the driver's seat in the negotiations. And if you have a realtor that's pushing you to buy, be wary, because your team of professionals that are working with you should be aligned with what you're trying to accomplish. And that is getting a good deal on good terms, and you should be buying without any stress or anxiety, okay? You need to be in control. So if your agent is pushing you, it's because they're looking after their interest and not yours. They're not on your team, they're on their own team. And that's something folks have to flush out when you're seeking out help, and try to avoid these novices that are just trying to get a sale to make a commission. They need to act professionally, understand what your game plan is, and make sure they're on your team representing you and your values and what your game plan is. So be very, very weary of folks that are trying to push you into a sale. Like, oh, this is a great time to buy. This, don't lose out on this property, blah, 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 blah. There's going to be more coming out. Last thing I want to talk about is jobs. Jobs are starting to erode. They're starting to go missing. We're seeing an uptick in unemployment. We've seen an increase from about 4.9% in unemployment to 5.8% in a very short period of time, the highest bump in a short period of time in 70 years, okay? So that will continue to increase, And one of the things I'm most concerned of is the average number of hours worked per week. That number has gone down 1%, and that doesn't seem like a whole lot, but in the grand scheme of things, in the last 90 days, that decrease in our average hours worked represents about 180,000 jobs lost. And when interest rates are going up and costs are going up and inflation is going up and there's an erosion of income because employers are not paying overtime, they're reducing hours because they really don't want to get rid of good employees, they're just cutting back their hours, they have less to spend. And when people have less to spend, that's not a good sign. It's a sign of erosion of the economy. We have less productivity. And with less productivity means a lower quality of life. Our quality of life is decreasing. And people need to understand that when the government talks about GDP growth, when you're growing by 4 or 5% in population and your GDP is going up, it doesn't necessarily mean it's going up per capita. As a matter of fact, there's some statistics that show that we are going downhill on a per capita basis, which means that our productivity is getting lower and lower each quarter. That is not a good sign, okay? And when you put this all together, the prediction for 2024 is it's going to be very, very bumpy. And with the quality of life decreasing, here are 3 things that folks need to focus on. Number 1, live within your means. Be frugal, okay? If costs are going up, quality of life is going down because you have less to spend on stuff, you need to take hold of your finances and your budgeting, and you need to be frugal with everything you do, every dollar you spend. Number 2, increase your income as much as possible. Talk to your employer, see if there's any potential new roles you could take on for a little bit more income. Find a part-time job, find a side hustle, do whatever you can to increase your income because you're going to need it to keep up with the high cost of inflation, the decreased productivity out there, and we're going to have to make up any shortcomings you may have on the borrowing side. So this is going to be an unbelievable challenge for folks. So getting ahead of it and seeing if you could come up with some opportunities within your existing work environment or elsewhere, do so because it's only going to help you long term. And the last thing, save your money. Save your money, invest in assets, do whatever you can, set up a prepayment, pre-purchase investment into a stock portfolio, a balanced EFT, whatever the case is, buy some real estate if you have the ability to do so with people, and focus on trying to find ways to build your wealth in these trying times because you're probably going to be the minority. And if you are the minority, there may be some opportunities there for you that aren't available to other people. So it could pose an opportunity to increase your wealth by doing some interesting things. Improve a property, reposition your property into multiple units if you can. Try looking at ways to help you get through this tough time. The next 12 to 18 months is going to be very, very difficult. And if you could prepare yourself and be proactive in getting through it, you're going to be better for it in the long run, and it's going to make your life a lot easier by just understanding what will happen around you. So hopefully that helps you out. If anyone has any questions, any comments today, I'd be happy to answer them. But for the most part, I wanted to keep it short, want to keep it very simple. And as far as predictions are concerned, it's going to be a tough road. And the prediction business is very dangerous. It just gets people into trouble. And I'm just going to forewarn folks that be ready, do your budgeting, understand the world you live within, and you should be fine.